Wall Street has made professional money managers look absolutely foolish since the middle of March. But on top of that, famed Wall Street investor and hedge fund manager is setting himself up to make another run at his biggest investment blunder ever in his career. I'll tell you about that in just a second. This is today's Next Wise Step video. Thanks for being here. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners and owners right here at Korhorn Financial Group. If you're new to this channel, hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, everyone's calling this the fear of missing out stock market rally, the FOMO rally, and guess what it's done? It has made professional money managers, hedge funds, and others look absolutely foolish. Let me tell you about Stanley Druckenmiller. Oh my goodness, you got to say that very, very carefully. So he's a famed Wall Street investor. He managed money with George Soros, and he even has been a hedge fund manager and so on. Well, back a few years ago, he shared his greatest investment mistake ever, how he was humbled. Here's what happened. In early 1999, he had been looking and saying, okay, these tech stocks are just wildly out of control, and he decided to short $200 million of tech stocks. Now, shorting, if you're not familiar, that's betting on the price going down. So he put a wager. I would call this not investing. That is gambling. Put a wager that tech stocks were too high and they were going to fall. $200 million. Just a couple of months later, he had to cover his short and lost $600 million. Because was he wrong? No, he was just early. All right. So that was later in 1999. As the saying goes, if you can't beat them, join them. For the rest of 1999, he said, forget it. Tech stocks, I'm just going to capitulate. I'm getting all in. $6 billion he invested in tech stocks over the next few months. 6 weeks later, he lost $3 billion because we know what happened to tech stocks when the bubble burst. Now, this is an individual hedge fund manager, mutual fund manager, a notorious Wall Street titan, okay? He was famed for breaking the Bank of England when he shorted things there. So, guys, this isn't some guy just playing around in his basement. This is a professional, okay? And he said, it was asked, hey, what lesson did you learn during that episode in 1999? He said, I didn't learn anything. I already knew that I shouldn't be chasing stuff like that, and I did it anyway. So there was no learning. I just needed to do what I already knew how to do. All right, that sets the stage for what's happening right now. We've had an enormous rally since the lows in the stock market. Over the past couple of months, the S&P 500 has risen over 40%. Well, in a recent interview, Stanley Druckenmiller came out and said, despite the rally of over 40% in the stock market, his fund, his portfolio has only rebounded 3%. No, that's not a 3% performance since the beginning of the year. That is a 3% rebound off the lows. So as the stock market crashed, as it's come back 40% from that bottom, his fund's only come back 3%. Is this now setting him up on another FOMO potential mistake? What is someone like that to do now? You've missed out on this rally. Do you jump in now saying, I guess everyone was right, I doubted it, I guess everyone was right? Or do you continue to stick to your guns and hope for the market to fall? What do you take from this? What should you take from this? First and foremost, your investing needs to be investing in principle based. It should not be gambling. If you are quote unquote investing, hoping that this happens or this happens, and if one happens, you win, if the other happens, you lose, that's not investing. That's called gambling. That's called gambling. And all sorts of people do it, and that's okay. That makes an efficient market for the rest of us. But for you, for most people, you should not be gambling with your nest egg. You shouldn't. You should be investing. So use a principled approached investment strategy, and that is using a diversified mix of low-cost index-type funds. That way you're appreciating when the S&P 500 goes up, when small caps are finally rallying like they are now, and international and so on. And you're staying disciplined with that approach because it's all connected to your long-term financial goals. But then you complement that with a momentum strategy. A momentum strategy is not gambling like Druckenmiller, okay? It's not saying, well, I think the market's gonna go down, so let's short, let's bet on the downside. A momentum strategy is following the trends. And so combining the two, you're going to be adapting and pivoting, overweighting and underweighting, taking more risk or less risk depending on what is happening in the market. That is a principle-based investment approach, and it's got to be connected to your long-term investment plan, your overall financial plan. Don't do that with college money if you've got a kid that's a senior in high school, right? That is short-term money. That money should be in cash and low risk. And if you're within a couple years of retirement, you should still have a good safety net, a moat around your financial house, dollars that you're going to be using in those early years of retirement. And that structure that I talked about, a diversified mix and a momentum strategy, should be for your intermediate and long-term dollars. So be principled with your investing. And the second takeaway, guys, this rally does have professional money managers scratching their head. Even though I've told you our clients have done fantastic because of that dual strategy, as a professional, I am scratching my head at this rally. It does not make sense, but we've never been through something like this before, a pandemic. We've never had the Fed respond as strongly as they've had. We've never seen central banks act globally in really a united way to invest and so much capital into the system. So maybe this rebound is justified. I don't know, but you shouldn't gamble and risk your financial livelihood on it. But brace yourself that this could be a FOMO rally and it could all dissipate and we could see volatility return here in the coming weeks and months. So just brace yourself for that. Have a disciplined investment approach. Brace yourself for more volatility. All right, you need a second opinion, you need to talk to a CFP team looking at your investment approach and how it connects with your long-term financial plan. You can always contact our team. You can find us online, corehorn.com, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.